I'm here with Kirk Paulus, Equity Data Analyst. Kirk recently wrote an article called Uranium Stocks Show Signs of Recovery After Fukushima Fallout. It can be found on Morningstar.ca and CPMS.com. It's now been 1 year since the earthquake and tsunami hit Japan, and subsequently the nation has faced a tsunami-driven nuclear disaster. Uranium mining stocks have still not recovered. So Kirk, tell me, why haven't they recovered yet?
Well, as you said, over a year has passed since the events in Japan and the fallout with the Fukushima reactor, and these events are still by far the most serious issue for the industry. The biggest concern was a possible pullback that world governments may have from nuclear power, as concerns over meltdowns and certain problems with reactors were starting to dominate the political scene. These fears were somewhat justified, with Japan currently decommissioning all of their reactors, and Germany on track to decommission theirs by 2022. If you add to this the current lows in natural gas prices, you can start to understand why the industry has taken such a hit.
And which Canadian companies were the hardest hit?
Well, the effects were felt pretty broad-based across the entire industry. But if we take a look at the global X Uranium ETF, you can start to get a feel for the drop that they've experienced. Approximately 50% of the holdings are in the three largest Canadian players: Cameco, Paladin Energy, and Uranium One. With uranium spot prices dropping from pre-crisis highs near $140 to a current trading range of $50 to $55, these firms were obviously going to feel the effects on their bottom line.
And Kirk, when we were talking earlier, you told me there were some signs of recovery with some mergers and acquisitions activity.
Well, often mergers and acquisitions can be a very positive sign for an industry that is coming out of a downturn, as it can show that the major players are starting to see value where others may not. For example, there was the 2011 battle between Rio Tinto and Cameco over a firm called Hathor Exploration. Rio Tinto eventually won it, but it's a very positive sign to see this kind of activity. Additionally, Denison Mines recently sold their U.S. assets, which is another positive sign for future mergers and acquisition activity.
And Kirk, what do you think will cause the industry to turn around?
Well, the most important driver will be the price path that uranium takes over the coming months and years. If spot prices begin to recover, we're going to obviously see some positive effects on the Canadian players in the uranium industry. The question is where the demand for uranium is going to be coming in the future. It's possible that some of the developed nations may pull back from their current fear of nuclear power as Fukushima begins to fade from memory and fears of another reactor meltdown start to also decrease. But from my personal perspective, I believe that future demand will mostly be driven by developing nations such as China and India, who are just voracious in their demand for commodities and new plants to start to help fuel their economy.
Okay, and I'm sure for the DIY investors watching, they're going to want us to take a look at a couple of stocks. So why don't we take a look at them, and we'll start with Cameco.
Well, Cameco is the largest of the Canadian players in the uranium industry, and currently they're looking to bring one of the new major global projects online at Cigar Lake in the Athabasca. From an operational standpoint, Cameco has been a very steady performer in the industry and is one of the low-risk companies in the uranium universe. I'm particularly fond of their overseas exposure as well, as most of the new growth in the uranium industry, as I said previously, will likely be driven by developing nations. In the short term, the biggest catalyst for the stock price will be how well they deliver on the Cigar Lake project. Currently, Cameco is trading at the $21 range with a price-to-earnings ratio of 17 times.
And why don't we take a look at Uranium One?
Well, Uranium One has a different profile from Cameco in that they're slightly more highly leveraged, and also their production is centered in Kazakhstan. Now, management has been successful in keeping their extraction costs low and have positioned themselves as one of the lowest cost producers in the world. However, as occurs with many firms with foreign assets, investors may perceive political risk, which can result in a discount to the trading price. Whether or not this is justified, Uranium One's extraction costs have remained both low and stable. This is a very positive thing, especially if they can take this structure to new projects they're currently working on in the United States and Australia. Stock's currently trading near the 250 range with a price-to-earnings ratio near 32 times. While they also carry a little bit more risk than Cameco, their higher leverage and industry-leading extraction costs would really benefit the firm if uranium prices do start to rise.
And the last stock I think we should touch on is Paladin Energy.
Paladin Energy is another one of the major players in the industry, but again with a different profile. They're more of a growth-oriented firm. They do have 2 operating mines in Africa and are working on some new ones in Australia. Additionally, there's a bit more of a concern about their comparatively higher debt levels that they're carrying. Especially, there's an upcoming refinancing of around $325 million in convertible debentures. Nevertheless, if the firm can continue to successfully ramp up their production while keeping control over their costs, they should benefit in the long term. Currently, Paladin's trading at $1.30, and they're just off their 52-week low of $1.07.
That's a lot of great information, and I only have one more question for you. For DIY investors watching that are hot on uranium, or they just think it's a great time to buy, what stock would you recommend?
Well, you always need to take a look at the situation of the investor and the risk profile and tolerance that they have. But my personal favorite is Cameco Corp. They're the largest player in the industry, and throughout the crisis, they have weathered fairly well. Operationally, they're very structurally sound. And also, as they're bringing on one of the newest large projects in the world with Cigar Lake, they should benefit if spot prices start to recover. And last point with Cameco I'd like to mention is their overseas exposure should be very positive if developing countries do start to drive demand and uranium spot prices higher.
Thanks so much, Kirk.
You're welcome.
To check out Kirk's article, go to morningstar.ca or cpms.com.